Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am doing awesome, Joe. I am hopped up on the bean this morning. So I got a lot of energy to kick this off today. Feeling good in the hood. What's going on over there with you?
Oh, I'm just waiting for the sun to come out. Seems like it's been gray for the last few days, but hanging out in Enumclaw.
Yes, and for all of you that are just hanging out, we appreciate you jumping on with us here every week on the Nuts and Bolts of Real Estate Investing. But Joe, I got a question for you. And that is, do you work out in the morning or the afternoon? I mean, like, is it best to work out in the morning? If you guys don't know what I'm talking about, we're talking about my partner, Joe, here is, if you haven't figured it out yet, is a awesome fitness and health guy. And you can follow along at the Get Better Project if you need a pick-me-up during this time that we're all still stuck at home here, or even after. I mean, it is awesome stuff. So I have a couple questions for Joe right now. So I want to know, when do you work out, Joe? And is there a reason why?
So the best time to work out is anytime, really. I mean, we could talk about some specific things around hormones and when would be best time to lift heavier weights versus do cardio. But really, it's just best to work out. So whenever it fits into your schedule, that's the best time. Good
answer. I guess that doesn't give me the excuse I was looking for then, unfortunately. So just so you know, I've started something with the girls. I have twin girls that are almost 12 years old, for anybody that cares to know that. But I am going to put, as part of their allowance, they've actually, during this pandemic stuff, they've stepped up and they have started cleaning the whole house, which is fantastic. Now they get an allowance for that. But I want to create a habit with them, which is the health and fitness stuff from you. So I am actually adding on to their allowance if they do your workouts every day of the week. Is going to be part of their allowance. So we're just kicking that off here in the next week, starting on Sunday. And one of them is super excited. And the other one is like, her style is more to usually pay her sister to do her work for her. So we'll see how that all turns out. But
wow.
Yes, absolutely, guys. We need to keep healthy and fit during this time. So please check out the Get Better Project on all your social media channels and see and plug in with Joe on that. But today we're going to talk about a different type of health, and that is the health of your taxes. Okay. That's right. Today we have with us back again, the one and only, who is just out there. I mean, if you haven't met or heard about Natalie Kolodij yet, you guys you got your head in the sand. I'll tell you that much, because Natalie is a CEO, a tax strategist, a real estate investor, and my favorite, a bulldog owner. Bulldog owner is what I meant to say. Flubbered that up though. Natalie, what's up today? How you doing?
Good, Julie. How are you doing?
I am awesome. And Natalie is joining us today from Charlotte. That's South Carolina, is it, or North?
North Carolina. But they're kind of almost the same place.
You know what? Last year, I think I said this on another podcast, we went to spring break in Charlotte, and we stayed out in a big old house in Isle of Palms.
Cool.
It was absolutely awesome. Loved it out.
We've got some awesome vacation spots out here.
I'll tell you what, I haven't been able to eat barbecue since I've been back, because the barbecue out in Charlotte is so insane. It ruins it for everywhere else, I think, in the country. I ate so much while I was out there. I'm, in fact, now thinking about it, now it's going to make me hungry this entire time that we talked today. But yes, I love Charlotte. You know what else I heard is that Charlotte, I think the CEO for Redfin, Glenn Kelman, or however you say his name, Kelman, is talking about how he thinks there's going to be an exodus out of big cities, and that people are already, the searches are starting to show up in some of these smaller cities. And at top of the list, he said, was Charlotte. So there you go. You just go start buying some more deals in Charlotte and maybe get your appreciation lift as people start moving out to the smaller cities.
Yeah. Oh, absolutely. Yeah, that's what it was for me with coming from Seattle to Charlotte was, get out of a high cost of living, work virtually. So why not live somewhere where you don't have to pay quite so much? So I think a lot of other people are now kind of seeing that same path, especially after having to work from home during these past couple weeks.
Right. So did you specifically move out there just for that reason?
Or did that was a big part of it. Yeah, I just wanted to come back to the East Coast. So I just kind of analyzed a handful of cities and figured I could sort of start in Charlotte, and it met a lot of my kind of check boxes. And if I didn't like it, the East Coast is so small, it's pretty easy to go somewhere else. But so far I really like it.
That is fantastic. Well, next time I'm in Charlotte, because I'm sure we're coming back, we have some major people that grew up are some of our best friends. The parents still live in Charlotte, and we'll be back there. So we'll have to get together once we come out there. Of course, if you ever come to Seattle, I would love to hang out as well. So if you ever make it back this way, but today, guys, we are going to do an overview of some top tax planning strategies. Some of you might not even have filed your tax return yet for 2019. Or you can always go back and amend your taxes. But first of all, we're going to get to the most important question that I have for you today, Natalie, and that is, what is the name of your dog?
Her name is Minnie Moo.
Minnie Moo. Minnie Moo. Is there a special reason why Minnie Moo got that name, or just was top of mind at the time Minnie Moo arrived?
Yeah, so she's a rescue bulldog, and she was bred to be miniature. So she's only about 30 pounds versus the 60, 65 pounds. And then she's all white except for a big cow spot on her back. So it just kind of happened. So now she's a Minnie Moo.
Excellent. Seems fitting very much. Well, Natalie has been on our podcast at least once before. Joe, do you know what number that was?
Yeah, it was number 90.
Number 90. Guys, go back and listen. We're going to drop it down in the show notes here, and you'll be able to find that. But if you have not listened to podcast number 90 of the Nuts and Bolts of Real Estate Investing with Natalie, it is so fantastic. You are missing out. Major nuggets dropped. I think one of our best podcasts that we've done, frankly. And you're going to learn today why that Natalie, we could talk to her all the time. Please follow her on all her social media accounts, and we're going to connect you with that at the end of today. But there's also podcast number 90 was absolutely one of the funniest podcasts that we've ever done at about 26 minutes in. Some of you know what I'm talking about, and some of you don't. And it's possible that something funny might happen again today because Natalie brings special skills, let's say, to us. So we're going to kick it off today. We're going to move forward. I'm going to leave you hanging with that little carrot there. Go listen to number 90, and let's kick it off here today. So last time we talked and we asked you about what your life story was and how you got into real estate. And so we're going to let people go back and listen to that. But one quick question before we kick it off is, do you have a new gig with BiggerPockets or a contributor, or what's going on there? I've noticed some BiggerPockets action. Yeah, tell us about that.
Yeah, so I'm now a moderator on the BiggerPockets forums. So don't spam on the forums because I will erase it. And just follow the rules. And I am also now an official contributor for the BiggerPockets blog. So I will be sharing tax articles on there, and that'll be sent out through BiggerPockets as well.
Awesome. And, and you are welcome to post any of those on the Seattle Investors Club Facebook page at any time. We love to hear anything you have to say or anything that you contribute. So that is fantastic. Congratulations. It's no surprise to me because you're awesome. So
thank you.
Let's kick it off today, guys. We're going to talk about an overview, like we said today, of some top tax planning strategies. Let's kick it off with the subject of house hacking. Let's just jump in. I'm going to let you take it from here, Natalie.
Yeah, perfect. Really, thanks. So house hacking is something I always like to bring up just because I think it is one of the ways a lot of people kind of get started in real estate. It's something we all hear about, kind of a great way to move into something, owner occupy. And then the problem is this term gets used interchangeably. People can house hack where you kind of buy a big house, like maybe buy a 3 or 4 bedroom house and you rent your other bedrooms. Or it's also called house hacking if you would buy like a 4-plex and live in one unit and rent the other 3. And both are great ways to get started, but it's important to note that the tax situation of those two things kind of comes out a little differently. So I just wanted to kind of walk through that because I know there's a lot of people who, when they get started, look for kind of either or, right? To them, it's kind of 6 of one, half dozen of the other, but tax-wise, this can be a little bit different.
And can I add a third, or maybe you tell me, is a third house hacking is simply where you buy a fixer-upper and you live in there while you fix it up and you stay in for a while, right? And you house hack while you live there. You do all the upgrades and basically flip it while you live there. And you can talk about how long you should stay, right? People are doing that and getting mass equity and able to put on much lower conventional loans or FHA type loans in order to, in fact, there's probably even some programs to help them do that. In addition to just moving in and renting out a few rooms or buying the 4-plex, which is probably my favorite way, or the duplex or whatever. So just throwing that one in there too. Hot topic.
Yeah, absolutely. If you do kind of a live in flip like that, the IRS code says if you're occupying it and owning it for 2 of the last 5 years, you can sell it pretty much tax-free. If you're single, you can exclude $250,000 of gains. So if you've got a good flip, that's something where you can move into it and do that work and then sell it. That's a huge amount of money to not have to pay tax on.
Yeah, one of my best clients, that's what he does. He moves his family in. They do a huge renovation. They stay there for 2 years, and he takes and moves that money on to the next one. I've watched it happen very well.
Yep, it's a great strategy. So that's a great way to avoid any kind of taxes on those renovations. When it comes to kind of a house hack where you're occupying it, if you rent rooms in your own home, so if it's your primary dwelling, not a separate unit, the best part of that is that it doesn't interfere with your 121 exclusion at all. So your whole unit is still looked at as your primary residence. So you can still sell it tax-free. You'll just have a little bit of depreciation related to the amount you depreciated only for those rental rooms. So it's going to be very, very minimal because on a shared space like that, you're only allowed to depreciate the dedicated rental space. So only exclusively business, exclusively rental use rooms. So the rental bedrooms, rental bathrooms, none of the shared space. So your overall 121 exclusion stays in place. That's the tax code that says you can sell your primary home after 2 years tax-free. Doesn't interfere with that. If you do a house hack where you buy a multi-unit, like if you buy a 4-plex, they're all the same sized units, and you live in one unit and rent 3, even if you've lived in it for 2 years, when you move out, only 25% of your gain would be tax-free under that primary residence exclusion because the other 3 units aren't within your same dwelling. So tax-wise, there can be a huge difference. Even though you're living in part of that building, only your part, your specific unit, qualifies for that 121 tax-free sale.
Interesting.
Yeah, so I think a lot of people don't think about that because they're still living in it, but that can cause you kind of an unexpected tax hiccup. It's important to note that you can do a 1031 exchange on the other 3 units. So if you go to sell a rental property and you want to roll your gains into a new rental property, you use a 1031 exchange. So your 1 unit you live in would qualify for your primary sale. And then the other 3 qualify for a 1031 exchange. So you can combine the 2 and still sell it tax-free. But you just have to know that that's the difference between if you house hack rooms in your one single family house versus house hack a unit in a multi-unit is the tax differences.
I have never heard anybody say that before. That is some ninja information right there, guys. I have never heard anybody say that. Not only that is that I didn't realize that you could exchange 3 units out of a 4-plex, right? And split it up that way. That is ninja right there. Good stuff.
So that's an important one to kind of tinker over, because I think a lot of people like the multi-unit, but if you think you're going to sell in a couple of years, that's kind of your plan. You might be better off doing a house hack in a single family because tax-wise, you could come out in a far better place.
Right. Wow. I was just taking my girls for a walk last night. We were walking the dog. They're 12 years old, and I was telling them how the first place they're going to get is going to be a house hack, as they get older. That's the plan as they get older, is to house hack for them. So this is and they're gonna do better than I ever did. That's for sure.
Yep, exactly. When I think back on all those wasted years in my 20s when I lived with roommates anyway, like, man, I could have owned this house and lived with roommates. Like, that's the way to do it.
Good stuff. Good stuff. Anything else on house hacking?
I think that's kind of the big thing. Another thing that I see a lot, this is just kind of a little tidbit to be cautious on, is if you're renting rooms in your house, as I mentioned, you're only allowed to depreciate 100% rental use areas. So you can't take any like partial percentage for like your living room areas you share with your tenants. So you have to just split it by the square footage for specifically those bedrooms. And if there's like a dedicated bathroom kind of thing. But for the overall house expenses, like your mortgage, interest, utilities, for those you are allowed to take a portion. So say it's 50%, like you have one roommate and you guys share the living room kitchen, you can still deduct 50% for your mortgage, interest, stuff like that based on those shared spaces. So you kind of have to have two tax setups because your deduction for your depreciation is more limited than it is for your overall expenses. So just be careful setting that up that you don't kind of miss out on one or overstate the other.
That's fantastic. Do you have any type of, I think we talked about this before, some sort of, do you have any like checklist or something that helps people fill that out for themselves, a little guide that we can share with our audience and with everybody that's listening today?
Yeah, so I normally do. I'm actually having them redesigned right now by someone who is much better at Excel than I am. So I'll have that in the next couple of weeks. And what I'll do is I'll share it in the group for the members for free. And it's just going to be something to set up these allocations for you so that you know your house hack is set up correctly for taxes.
Oh my God. We love it. Thank you so much. Good stuff. Well, what else you got?
Perfect.
Let's keep going.
Yeah. So another item that I think is a huge benefit when it comes to rental real estate that we don't see that much, and this is something you should strategically be kind of thinking about and that your tax professional should be putting some time into, is sort of what I call like a mini cost segregation. So we've all heard of a cost segregation where pretty much in a rental, your house is a 27.5-year asset. The IRS says you depreciate it over that many years. When you do a cost segregation, what they do is they separate out all the components that make up your house and break them off into their shorter lives of 5 or 7 years, your electrical system, your flooring, this and that. So to do that, you normally need a cost segregation, but there's a handful of things that don't require a cost segregation. There's a handful of things that are, by kind of IRS definition, a shorter life and technically not structural, not permanently attached to your property. So that lets us separate those out. When you buy and renovate a house, we can separate out these items and deduct them over their shorter lives of, say, it's a 5-year asset. So now you get to deduct the whole expense over 5 years versus 27.5. You get a way better deduction. The other thing is that any assets with a life of less than 20 years qualify for something known as bonus depreciation. And that's basically a fancy IRS code saying you can write it off all in the first year. So if you buy, and especially like you do a BRRRR or you buy rentals and you do a renovation on them, there's a handful of things you'll want to make sure you track the costs on, because there's a good chance we can separate these out and deduct them all at once. So you don't want to just hand your CPA an invoice that says $40,000 rental renovation. We want to separate out these things. So the first one is your appliances. Even if you do a full kitchen renovation, your appliances aren't permanent. They're not attached. So we can always deduct those separately. That's a 5-year item. So make sure you track your appliances cost. Another one is carpeting, specifically carpet, not other flooring types. So the IRS is just not attached. It's not part of the property. So you can always do that with carpet. Kitchen cabinets is another big one that can almost always be expensed that a lot of people skip. and potentially the countertops. You have to keep in mind with this, it's sort of a what is attached permanently to your property rule. What can a person easily remove? So if they're sort of manufactured countertops, we've got a better chance versus if it's slab stone and it's going to take 4 people and a jackhammer to get them out. So anything as you're doing your renovation that seems, like I said, those key items. Another big one that I see missed a lot is what's called land improvements. So land improvements are a 15-year asset class. So like we said, anything under 20, we can use bonus depreciation on, lets us expense it all at once. And land improvements are going to be like your landscaping, if you put in a new driveway, new pavement, mailboxes. So kind of any of those outside projects, keep track of those too, because we can potentially write those off all at once. So that's another thing I see just skipped a lot that can result in a big write-off versus having to deduct a little bit over 27 and a half years.
So this is awesome stuff. Let me ask you, so let's say somebody, had their primary they were living in their first house, right? And it was their primary, and then they moved out. And this is how a lot of people get started in real estate, right? Is they move out and get their second primary and they keep the first one as a rental, right? And so is there any notes that we need to know? Like, so if it's your primary, you're not getting these write-offs, right? But then when you go and you move out and you move to your new primary and now it's converted to a rental, you can start, let's say you do a little renovation or do carpet replacements or whatever you have to do. Some of those things are, could be almost like turnover costs, right? Appliances and carpet.
Yeah, absolutely. So even if it starts as your primary, track anything you're doing at that point as well. It's either going to get added to your basis when it turns into a rental, that amount we can depreciate, or we might be able to expense some of it, but just keep track of it even while you're living in it, even though it's before it converts over. It's still part of the cost of like getting it into rental shape pretty much. So you'll just want to keep track of that as well.
Good stuff.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Good stuff. Any trickiness with like whether it's like a single family or a condo or anything like that? There's no weird condo stuff related to that. Just because sometimes I guess it doesn't matter, right? If it's condo or a house.
Yeah, it shouldn't change it up too much. The only thing that's a little weird is if you are like house hacking a small multifamily, you'll have to kind of keep almost 2 sets of tracking or just know that you need to split it up because like if you put a roof on it, that's split between all 4 units. 1/4 of those you don't get to capitalize right away because if you're living in that, it's not a write-off when it's your primary. But then if 3 years later you move out and rent that one, now the whole building is rental use, and now we can add in a little more cost for that roof. So it's just a matter of tracking everything, and your accountant should be able to kind of put the pieces in the right place. But it's like you need to hand them over the puzzle box with all the pieces in there, and then they can put together the puzzle.
Right. So you're saying if it was your primary and let's say you're in a 4-pack of a townhome situation where there's 4 townhomes and there's some shared roofing going on. If you live there, while you're living there, you put a roof on, and that's a shared cost between you and the other 3 townhomes there. But then let's say you move out 2 years later, you can still go give your CPA or your accountant that information because it's a useful life thing, and they can still write that off, that portion of yours, now that it's a rental, even though you did the work while it was your primary. Is that what we're saying?
Yeah, you would most likely add it to your basis in the property, your cost of the property. The way the IRS looks at what a rental costs is all expenses it took to get it kind of rent ready. So you couldn't rent a house with a leaky roof. So even if you replaced it before it was a rental, that was a cost that went into making it a livable, rentable unit.
And how about for people that are like, dang, I should have done that? What about going back and amending? Is it worth it to go back? It just depends on, I guess, the dollar amount, the cost to go back and amend, and the benefit that you're getting, or what's your info on that? Should we go back and amend at all for these things if we haven't done that?
Yeah, so sometimes it depends on kind of what's wrong. Depreciation is kind of a weird item because often if it's been wrong for 2 or more years, there's actually a specific form you can file in the current year to sort of fix it. So talk to your tax professional, or if that's who kind of missed it to begin with. If you're switching to someone new, this is something we have to do a lot, is we'll look back over those depreciation schedules, what was or wasn't capitalized, and if it was done correctly. So it might require an amendment, or it might require a Form 3115 to fix it in the current year. It depends on circumstance. And then I would just, I normally tell people whether it's worth it from a financial standpoint or not, like if you'll get enough back to cover the cost of amending and fixing. And sometimes you have to, if it's something that's going to be fundamentally wrong forever, unless you fix it, like it's something that's going to be substantially incorrect on all of your upcoming tax returns. But if it's something that's not huge and it's kind of immaterial, then you can sort of decide if it's worth it or not, or if you can just correct it going forward.
So the one thing I'll point out, you guys, everybody that's listening here, is that if your own accountant or CPA, if you own rental properties, is not bringing this up to you and asking you these types of questions, then you might want to consider that it might be time to switch to somebody that specializes and is a ninja in this type of tax planning and tax strategy, especially if you're in the business of, real estate investing. So think about it, and we'll keep going here. These are all such awesome tips. Kate, let's just see what else you got. What else you got?
Yeah. So the next thing is a really great strategy. You'll hear it kind of abused almost online. So really be careful with who you take advice from on this. But the next suggestion is that you are legally allowed to employ your own children. And this is fantastic because anyone who makes less than the standard deduction, which is about $12,000, doesn't have to file a tax return. And if you're employing your own children, you also don't have to withhold payroll tax on that. So they don't pay any of that FICA Medicare. So what this means, and then additionally, on top of that, you can also fund an IRA for them, which is another $5,500. So theoretically, each year you could pay each of your children almost $18,000 tax-free. So they don't have to file a tax return. They're not paying tax on it because they're under that filing requirement. And basically what you're doing is shifting money within your own household from your, higher tax bracket into zero for things they might have needed money for anyway. If your kids needed $10,000 for the year for school tuition, for you to pay that, you had to have earned $10,000 plus 30% or whatever your tax rate is to have that $10,000 in pocket. If instead you're paying your children with 0% tax and they're paying their own tuition, it's tax-free. We're at a much lower bracket. So we're just shifting income within your household from your bracket to a 0% bracket.
Absolutely insane. And the
It's
kids have to be what age is there?
So there's not a set age. There's kind of, depending on your state, labor laws vary from employing just anyone to your own children. A lot of the time there's kind of an exception there for a family business. But the most important part of this, and what I tell people, is that you have to pay them a reasonable amount and they have to actually do the work. So I get into this argument sometimes when someone's like, oh yeah, I paid my 4-year-old $18,000. And I was like, well, what did your 4-year-old do at minimum wage to earn that much money? You know what I mean? That means she worked 35 hours a week. She's 4.
Yeah.
So like, I don't think she's got that attention span and she should probably go to school.
Some of
So
the tiger moms out there are like, yeah, no.
yeah, like only 35 hours.
Uh-huh.
Yep. So you just want to make sure you're being reasonable with it. As your children get older and learn more, especially if you're, taking them to your projects, they're learning about real estate, they're helping with more things, you can obviously pay them more, you can raise the amount of hours they're working, but it has to be a reasonable payment for what they're doing. So you can't just say from day one, we're going to max it out. When they're 5, 6 years old, they might only be able to earn a few grand a year. And then it goes up as they get older and you adjust accordingly. So it's just important. It's something that gets audited. It's just kind of, like I said, kind of a highly sort of abused area where people sort of try to push the limits. So just be reasonable with it, but it's a totally allowable deduction and it's a great strategy. So work with your tax professional and make sure you're setting it up correctly and then put those little kids to work.
And do you need to be any specific type of entity, in order to do that? Or can I'm sure there's people out there, obviously, that are, still filing as a, sole proprietor type stuff that are listening. Does it matter?
So you can be a sole proprietor or a single member LLC or a partnership as long as the only partners are the two parents. So it doesn't work if you have a corporation, but if you just have your rental properties in single member LLCs and your kids are working on the rentals, then you can get an EIN for your LLC from the IRS and you can employ your children.
So if you own rental property with a partner, it's not going to work.
Correct. Yeah, you wouldn't be able to do that unless it was just yourself and your spouse as the two partners.
Got it. Good stuff.
Yeah, so that's a good one. Like I said, be careful. It's one of those things you just see a lot of smoke and mirrors kind of videos about, and it sounds extraordinary, but I don't want you getting audited. So go about it the right way and you still get a great advantage.
That is a question though. Are any of these things, let's say you took advantage of all the stuff we're going to cover today and you really were ninja, as we all should be. Does it put a spotlight on you a little bit for audit or at all for doing these things? And maybe we don't care as long as we have a smart CPA, honestly. I mean, we don't have to be scared of audits if you're doing things right.
Yeah, exactly. And that's kind of what it comes down to. And then there's certain myths about a home office deduction is something you'd always hear oh, you don't want to claim that, it triggers an audit. I hear this all the time. And I always hear it from people who tend to have older CPAs because that used to be true. But in 2010, the IRS announced that it wasn't a big deal anymore because we have the internet. Now working from home isn't as crazy as it used to be. It's totally normal now. So make sure you have someone who's kind of up to date on things and knows what are red flags. And even if they are, it kind of comes down to your risk tolerance. What I tell people is if there's sort of a strategy we're looking at and it's a little more aggressive, I'm going to let you know the risk and you'll kind of be able to make that decision if it's worth it for you for the savings. But you should your tax person shouldn't ever take a position on something tax-wise that they don't feel is defendable. They shouldn't, file something that they don't think they can back up by sort of a Hail Mary move. You want it to be something you can be aggressive, but it has to have some kind of legs to stand on.
Makes sense. All right, let's talk about planning for rental losses and having a plan with that.
Yeah, so this is another thing where I think people kind of push them to this. They don't really put much thought into it. And I think this is a really important area of your rental business. So rentals generate passive losses. And normally you can't use passive losses against active or ordinary income. They're just like oil and water, they won't mix. The IRS has a small exclusion where if your adjusted gross income is under $150,000, you can use some of those passive losses up to $25,000 a year to reduce your regular income. So that's great. That means, if you're making $100,000, $90,000 at a job, and you have 5 rentals with a $10,000 a year loss each, you've got $50,000 of losses to offset your $90,000 of earnings. You only pay tax on $40,000. So it's a huge benefit. But then if your income is above that 150 mark, and that's the same for single or married, so it happens really quickly, especially for married taxpayers, then your losses get stuck. You can't deduct them each year, and they roll forward to the next year until you have some ordinary income some passive income that the passive losses can be used against. So you don't lose the losses. They don't ever disappear, but you might not get a direct benefit each year. And this really disappoints some people because that's what they hear is, you need real estate, you're going to get a bunch of write-offs. But if your income is too high, you can write off everything you want, but it won't be able to apply against your regular income. It won't change your tax situation. So for these losses, what I tell people is you still want to maximize them because you get to use them at some point. What a lot of people don't realize is that when you sell a rental property, the sale of a rental, even though it's capital gains, it's looked at as qualifying in that same bucket as your as your passive losses. So when you sell a rental, if it's had all of these losses in previous years you couldn't deduct, those become available in the year you sell it to offset your sale gain. Additionally, any of those passive losses from your other properties can be used to offset that gain.
And so people need to think about that, like, because they feel like, how do we roll in the 1031 exchange conversation into that, right? So, sometimes it can be tough to find a 1031, right? Or people feel like maybe they buy something that isn't perfect just to kick the can down the road with a 1031. But maybe if they had some of these built up net operating losses or, stuff they've been carrying, that might help solve it as well. I'm making this up.
Yeah. Oh, absolutely. So that's what I tell people is it's important to think with real estate a few years down the road, because kind of what's your plan? You could literally have it structured where if you generate X dollars of losses each year, every 10th year, every 5th year, you sell a property and that's going to free up maybe $100,000 for you. But if you have enough losses to offset it, you can have a tax-free sale once every so many years. We can kind of plan this out. And so we can use it, like I said, for other things too, like those losses become available the year you sell it. So with some good tax planning, you're going to have potentially a lower income year even than you thought with the sale. So we can plan for some capital gains in that year or other things that are more beneficial to you while you're in a lower bracket. So pretty much just keep in mind those losses, keep an eye on your tax return at those rental losses each year, your passive activity loss worksheet, and see how much you have kind of saved up with each property, because when the property is sold, those become available. So
you guys should be paying attention to what your losses are. So, like if you're getting ready to sell something, right? But let's also remind everybody that, with all this said and talking about taxes, we always want to remember and keep in mind, especially as real estate investors, that you need to protect your ability to borrow, right? Because investors, we're talking about write off as much as we can, lower our taxable income as much as we can, but we do want to backstop that. Correct me if I'm wrong, Natalie, with making sure we're still financeable. Yeah, absolutely. And there's certain things that a lender should add back. So depreciation, a lender should always add back because they know that that's not a cash outflow. It's not a recurring expense. So taking those big depreciation losses using bonus depreciation, your lender should kind of back that back in to show how financeable you are. But absolutely, it's another one of those things where like with your losses and kind of timing when you use them, you might time that around when you're planning to buy new properties. Like you have a year where you want big losses and you offload a property and use all those prior losses. And then the income from that the following year you use to buy something new. When your income's back up to normal, you don't have those losses in that year. So it's got to be planned and look at kind of a few year span so that you have an actual sort of roadmap for what you're going to do instead of just letting the chips fall. Absolutely. I think this is the piece of the pie. It's getting talked about more because we're meeting people like yourself, but I feel even some of the biggest players, it's like the last thing they do is the tax planning. I don't know why it seems that way, but I think it's just, it's intimidating and a little bit, more, maybe people think it's more complicated. But why we love Natalie, guys, is because she spells it out in a way that makes it not complicated. That is your gift. I'll tell you what, Natalie, that is an absolute gift that you have. So we appreciate you so much with all this stuff today. We're going to keep having you on and on and on and on. As much as we can. Absolutely. Anything else you want to add to the rental loss stuff, or?
Yeah, I'll just add one quick tidbit, just because this has been kind of going around and confusing, I think, a lot of people, is part of the CARES Act. One of the changes with that was an ability that kind of brought something back from older tax law, but pretty much you can carry your net operating losses backwards. So if you had some in this year and you had income in earlier years, you could go backwards, carry the loss back, and offset that income to generate a refund. But it's important to note, and this is what's been really confusing, is a lot of the articles on this weren't clear and made it sound like being a landlord automatically kind of qualified you for this because of depreciation. But passive losses, the losses your rentals generate, aren't the same as net operating losses. Net operating losses are a business loss, and you only have that on your 1040 when you have two situations. You have to be a real estate professional. When you're a real estate professional, you don't have that passive loss cap, and it kind of changes the nature of your losses. So if you're a real estate professional, and if you had rental losses that were greater than all of your income for the year, you would have a net operating loss. If you're a regular person who's not a real estate professional, and it doesn't matter if you have $10, $20, $100,000 of passive losses, those don't qualify for this carryback provision. So it's just something that's been kind of convoluted in how it's been said. So I just wanted to kind of clarify that if you're not a real estate professional, there's a good chance it won't apply to your passive losses from your rentals.
And so for our people out there in tech and our medical professionals and some of our, other business professionals that are investing in real estate and working their full-time profession, is it possible for them to qualify as a real estate professional? Because, people probably have stocks they can sell, and have those gains offset somehow if they can qualify, right? Because that would count, or what?
So real estate professional is kind of a tricky one. There's two tests for it. The first one is spending 750 hours a year in real estate, which most people can do. Like, that one's pretty easy. But the second one is that you can't spend more time in any other combined activities than you do on real estate. So most full-time jobs are at least, 2,000 hours a year. So it's pretty rare to qualify if you're working a full-time job. The tax courts love throwing it out. But kind of another little tidbit is that if you're married, only one person has to qualify and both people receive the benefit. So if you're a doctor and you're making $300,000 a year and you love your job, and your spouse works at a pet store and they like their job, but they make $15 an hour, they might want to quit their job and manage your properties to qualify for this real estate professional status. And what that does is let you deduct all of your rental losses, no matter how much they are and no matter how much income you make. So you could potentially zero out all of your W-2 income if you had enough rentals generating enough losses.
So what you're saying is, if you love your day job, you better also love your wife or your spouse.
Yes, right? Pretty much.
There you go, guys. We're bringing marriage back in full force here. So that is ninja tips right there. Such good. I mean, where do you hear this stuff, guys? This is such good information. I love it. I'm a accounting major, myself. So this is, of course, I'm don't work in accounting these days, but I love checking in and hearing all this just to geek out with you on all this stuff. Fantastic stuff. Good stuff. And do we have one more that we can cover here?
Yeah, the last little quick tip. Yeah, your everyday expenses. So this is one of those things that's kind of the benefit with any business. You'll hear tax people say, if you go to a tax professional and all you have is your W-2 income, that there's not a ton they can do to really help you. And that's because our tax code is designed to be preferential for business owners and for real estate owners. So once you start investing in real estate, keep in mind that some of the things you're paying for anyway right now might now become deductible or partially deductible. And I see this missed a lot. So those things would be like your home internet. there's a good chance you're managing your properties from home. Even if you don't have a home office, you can write off a portion of your internet, a portion of your cell phone bill. If you do have a home office, you can potentially qualify for that as well, as long as your rentals are operating like a trade or business. Some of your mileage, if you already pay for, a RIA membership or a BiggerPockets membership. So these are a lot of expenses I see missed, are things that they might not be like specific expenses to a property. So I think a lot of people don't even think about them, but consider anything you pay for already that you're now utilizing in some way for your business. And then make sure you ask your tax person. It never hurts to ask and say, hey, I subscribe for Audible. Can I write that off? And if everything on there is real estate and business books, then yes. So just keep that in mind.
There you go, guys. Join Seattle Investors Club, listen to all our podcasts, and write it off. There you go.
Yep.
Right there. Good stuff. Such good stuff. I don't know. I could talk to you forever. I could talk to you forever. Anything else you want to add before we start wrapping up today?
Man, I think that is kind of the gist of it. Right now, things are a little crazy with the CARES Act. So just be cautious with what you're reading on the internet. And a lot of people like to kind of blast out information before it's finalized. So run things past your tax person before you kind of take it as, written scripture. Like, make sure that that's the most updated, finalized version of, of a bill or whatever they're looking at. So just be cautious right now. There's a lot of information out there that becomes obsolete a week later. So just do your due diligence, check with your professional, and try not to get overwhelmed by all the changes.
And I'll add on top the forbearance discussions that are happening right now, and the news that's coming out about forbearance. I can see as of yesterday, people are shouting from the rooftops how great it is that you're going to be able to refinance if you went into forbearance, if you've paid, I think it said 3 months of your payment, you're back maybe in graces or something like that. I'm paraphrasing, so don't listen to me here, guys. But I caution anybody actually taking action based on some article that somebody posts. And, if you're in the Seattle Investors Club Facebook group, as I hope that you all are, because we continue this types of discussions every day, all week, I suggest that we have our conventional lenders that are in the trenches on that really interpret that kind of stuff for us rather than just read an article that somebody posts.
Yeah. And that's kind of what I tell people is when it comes to my guess is it'll take a little bit for the lenders to put out kind of accurate, thorough information. So a lot of the information that comes out first and as quickly as possible, it's just sort of general industry people, right? Like a tax professional, I'm not going to write something on it till we have the finalized through all of the House and Senate version of something. So anything that comes out immediate is probably not going to be from the best sources, because the best sources are waiting because they have to analyze it. They're going to read through it thoroughly. They're going to make sure it's the final version and that everything they're giving you is correct. There's a little more kind of skin in the game for them. So just, grain of salt.
Yeah. And regarding the forbearance discussion, which I feel is even on the news, King 5 News last night, they blasted out about all this forbearance stuff. I just feel it's so irresponsible because we don't really know how the lenders are going to put that into practice, because they have the opportunity to have their own overlays and their own rules and all that stuff on top. So, caution on that, you guys, and keep plugged in. Again, we're talking about that on the Seattle Investors Club Facebook page. It's free to join that. Jump on there if you haven't already. And all good stuff, boy. So we will be having Natalie back with us, guys, on a regular basis if she doesn't get too busy with all her other stuff, because everybody, the secret is out that Natalie is a rock star. And we've known that for some time. And I want to give a shout out to my buddy, Troy Fisher, who is the one that introduced me to you, Natalie. And I want to give him some props. We love Troy. Thanks, brother. And I'll say to you, honk, honk, beep, beep, Troy. You know what that means. So, so Natalie, best place for people to follow you, and where are you posting you post these tidbits of information very simply, just like one little subject matter. Where can people, and it's just so easy to understand how you roll. Where can people follow along and stay in tune with you?
Yeah, the best place is on Facebook, honestly, at Kolodij Tax, Real Estate Tax Strategist. So if you'd like that page on there, that's where I tend to kind of just share those little snippets and updates pretty much as these new laws come out, as things change. I take kind of the key points, the sort of the things I think are most important to know, and just share those little tidbits. It's just sort of planting seeds. I'm not going to deep dive on everything, but just to kind of give you a heads up.
Right. And you have, as unique as you are, your name, the spelling of your name is also unique. So if you want to let people know, spell it out for them where they can jump on there just so they get it right.
Yeah, it's Kolodij tax, TAX. So if you type that in, it should bring up my business page, or you can add me on Facebook as well. I've got a lot of investors on my Facebook.
Super awesome. And are you able to help taxpayers and investors in any state, or what's your reach there?
Yeah, we work with clients actually internationally at this point. We have clients all over America and in other countries as well.
Awesome stuff, man. Good stuff, guys. As you can see that there's no doubt we're going to recommend that you give Natalie a call to get all your tax stuff not only going in the right direction, but maybe straightened out from the past. Again, we'll remind you to go listen to podcast number 90, where you can get to know Natalie better, as well as listen to some of the serious nuggets she dropped on that podcast, including how you can go back and look at your tax return. I think on that one, you had given us some line items to look at, to go back and test and see if your current accountant or CPA is doing things right by you. I recall on that podcast. So go back and listen to that. And enjoy your weekend coffee with Natalie. I know I'm going to have Joe resend this recording to me right away, so I can listen to it again right away as I move forward myself. So good stuff. Joseph, what kind of reminders do we need to give you guys right now? And Natalie, we want to encourage you as well. So every Thursday, guys, at 11:30 a.m. Pacific time, doesn't matter where you are in the United States or wherever you are welcome to join us on our online weekly meetup and mastermind. I'll call it a loose mastermind. It's just like a peer-to-peer group full of anybody that's a real estate professional, whether you're new or, you've been in the game for a while, or you're, been in the game for a long time with a lot of experience, and brokers and wholesalers and conventional lenders, private lenders, 1031 exchange experts, accountants. Hopefully we're twisting Natalie's arm to jump on with us from time to time when she can. And it's an online weekup from 11:30 to 12:30 every single Thursday, Pacific time. And you can grab the link to that meetup simply by jumping on the meetup.com page for Seattle Investors Club. Go on to meetup.com, search Seattle Investors Club, and you will certainly find that. And you can grab that on Thursday mornings. We'll also remind you if you're on our list, or if you, our email list, or if you are on our Facebook page. But please, the best way for us to communicate with you, I think Joe will confirm, is to jump on and join our meetup.com page for Seattle Investors Club, so we can continue to provide you with all these ninja insights and tips related to the world of real estate investing and just real estate in general. One other reminder is that our friends Tarl and Grace Yarber are still planning to have the Pacific Northwest Big Badass Real Estate Expo. They have moved that to a date in August. I don't have those dates off the top of my head. I don't know if you do, Joe.
The 6th through 8th.
The 6th through 8th. There you go, right there. August 6th through 8th. That is going to be the place to be this summer, especially if we're all able to get back together. But one way or another, they are going to be able to continue on with that expo. And I highly encourage you to plug in there. And it is going to knock your socks off on the different topics that'll be covered at that expo. Best one I've ever been to. So I think you'll find the same. So we'll be posting that as well on the Seattle Investors Club Facebook page for you guys to stay connected to the Pacific Northwest Big Badass Real Estate Expo from wherever you're at. And other than that, Joe, where can everybody find the details of today's podcast?
Yeah, you can get to all the show notes by going to seattleinvestorsclub.com/119. That's seattleinvestorsclub.com/119. And if you enjoyed this podcast, head over to seattleinvestorsclub.com/iTunes and give us a review. We'd love it.
We would love it, guys, because when you give us great reviews, that makes us look good, and we are more and more and more able to get stellar and highly sought after podcast guests like Natalie on our show. So we really appreciate it if you can help us out there. And we enjoy talking to you every single week. And Natalie, just to cover it one more time, once you're ready, you're going to be posting some sort of helpful worksheet related to tracking some of the stuff we talked about today. Once you get that all worked out with your Excel experts there, is that right?
Yep, exactly. I normally have a handful of downloads on my site. I'm just having some redesigned. So once that one is wrapped up for the house hacking setup, I will go ahead and share that to the group.
Awesome stuff. So make sure you guys join us on our Facebook page at seattleinvestorsclub.com. Other than that, we're all going to go get back to work, and I hope you are all of you are and your families are staying safe and healthy during this time that we're still dealing with this virus. We care about you all, and we enjoy having what I'll would like to be a real relationship with you guys. Anybody that has a question about anything, you're always welcome to reach out to me. Either hit me up through Facebook on Messenger, or you can, call or text me. Probably texting I prefer at 206-910-2985. I think most of you know I'm a local real estate broker here in Seattle. So if you need any help with anything, I have a multitude, just insane amounts of options that I'd like to talk to you guys about for any of your properties. Or any of you wholesalers too. Give me a shout. I've got a lot of ideas for you guys right now. So look forward to it. Again, to keep your health in check, you're going to go check out the Get Better Project, which is Joe's spectacularly awesome health and fitness program that you guys can engage in. And other than that, we shall see you later. Over and out. Thanks a lot for listening.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.